Hands up if you want to reduce risk and increase reward on your supply and demand zone trades. For many traders, this sounds way too good to be true. However, there is a simple way: entering using a lower time frame. What we're going to do is, rather than enter on our zone time frame, the time frame we draw our zones on and take trades off, we're going to instead enter using a lower time frame. That will allow us to get a much tighter entry, cutting our risk significantly while increasing our reward at the same time. Sound good? Here's what you need to do. Now, when I say enter using a lower time frame, I don't mean dropping down to the 1 minute when you trade supply and demand on the 1 hour. That would be silly and probably cause us a ton of losses, which we definitely don't want. What I mean is dropping a time frame or two below our trade time frame and watching for entry signals, like pin bars, engulfs, or the secret patterns mentioned earlier. See, in Forex, price is fractal, okay? How price changes is always the same. However, we view the changes differently depending on which time frame we're using. Candlestick patterns are a great example of this. Look at this pin bar on the 1 hour chart. Now here's how it looks on the 30 min. It's become a piercing pattern. Why has it changed? Because we're seeing price in more detail due to the lower time frame. If price is condensed into a single candle, we get a bullish pin bar. But if we drop a time frame and see more detail, we see a piercing pattern. So we're seeing exactly the same price change, but it appears differently based on which time frame we view it on. This is why Forex is a fractal market. Now, because of this, Forex being fractal, it means what we see on one time frame is just as valid as what we see on a different time frame. A piercing pattern on the 30 minute, which appears as a different candle on the 1 hour, is just as valid a signal as a pin bar on the 1 hour. So even though a pin hasn't formed on the 1 hour, we can still use the piercing pattern on the 15 minute to get in, because it's formed for the same reason. We just can't see it due to the time frame difference. Because of this, we can use lower time frame signals to trade higher time frame zones. That way we can reduce our risk while at the same time increase our reward. So how do you enter on a lower time frame? Well, here's a step-by-step guide on what you need to do. Before we can enter using a lower time frame, we of course need to wait for price to return to a zone. In this case, let's wait for price to return to this demand zone. This is what we'll use for the example. Now, as soon as price reaches our zone, we switch down to a lower time frame to begin watching for entry signals, the same signals we would normally watch for on our trade time frame: pin bars, engulfing patterns, and the two secret patterns. Because we're using a lower time frame, these signals appear much smaller than on our normal time frame, which allows us to decrease risk and simultaneously increase our reward. But which time frame should you switch to? How low should you go? Here's a quick list of what I use. Again, if your time frame isn't listed, like the weekly and 1 minute, that's because I don't consider them trade time frames. They're too low and too high. The banks aren't active on these time frames aside from scalpers and algos, which use the 1 minute, so there's no real point using them in our trading. So, since this is a 1 hour zone, let's drop down to the 15 minute time frame and see if any entry signals form inside our zone. Okay, so you can see we have quite a few different entry signals on the 15 minute. We've got a couple of engulfing patterns here, and there's a few pin bars you can see too. But here's the thing, these patterns, all of them, are not valid entry signals, okay? You can't use them to trade the zones, they're all too small. Like I said earlier, the entry signal into a supply or demand zone trade must be big in terms of overall size. Pin bars must have a big wick, engulfing patterns must have a large second candle. This is because size reveals strength, it shows how much the banks bought or sold. If a large bullish engulfing pattern forms, that tells us the banks entered a large buy position. How else could price rise so significantly after initially falling? That makes it a stronger signal price is going to reverse. So these tiny patterns we can't use. We must wait for a large pattern to form, a pattern like this for example. See the difference now? This pin bar is much bigger than the other pins you can see. Its wick clearly sticks out from the surrounding price action, making it obvious to see. The big wick tells us, though we can't actually see it, the banks bought a huge amount. This is evident if you think and look at how it formed. Initially, price was falling strongly, which led lots of traders to sell. They thought price was breaking lower. The banks then bought into those sellers, which took a lot of money due to how many were selling. Price proceeds to rise, and what do we see form? A bullish pin bar with a really large wick. We know this pin is a strong signal because the big wick tells us the banks had to buy a huge amount to make price rise, which they'd only do if they were confident price was going to reverse. So this pin bar is a good entry signal. It confirms the banks want price to rise. Now, if you look at where the pin forms, you'll notice it's closer to our stop location than the 1 hour entry. This is how a lower time frame entry decreases your risk and increases your reward. Being on a lower time frame, this pin forms much closer to the zone edge than the pin on the 1 hour, giving you a tighter entry. You can see this below. On the 15 minute, our entry is at 105, 200 points away from our stop location. If we switch to the 1 hour, however, our entry on here, the bullish engulf, which isn't the greatest engulf either, is at 105.077, 277 points away from our stop. So by entering on the 15 minute, we cut our risk by 77 points, which is a huge amount, especially across multiple trades. And that's not including the 150 point cushion between the stop and zone edge. So really, we cut our risk by almost 200 points, a massive decrease. And of course, that increases our potential reward on the trade too. Our final step then is to enter the trade and place a stop loss order. Here's what you need to do. As with entering on the higher time frames, when you see a pattern form on the lower time frames, you must always wait for the pattern to close before entering your trade. So in our case, we enter once the candle after the pin opens. That confirms the pin is a valid signal and we can safely enter our trade. All that's left to do now is place our stop loss. Again, just like trading higher time frames, the stop always goes either above or below the zone, depending on the zone of course. Once you've entered, you can switch back to your trade time frame. You don't need to keep switching back and forth between them, you can just stay on your normal time frame and then monitor your trade from there. See what price does and how things pan out. And as you can see, in our case, price reversed soon after the big pin bar formed. Now you just take profits using the method I outlined earlier. Simple. Try this out yourself for a while, see how you get on. The lower time frames might not be your cup of tea, but they can really help tighten your entry up and make your trades more profitable. And with that, let's move on to the next one.